All right, Evan. So what do we got question-wise today?
Cool. So most of the questions we're going to focus on today is a little more long-term investing. As some members already know, we kind of built a long-term chat for people so we can focus on that stuff. So we had some great questions from there. But kind of one of the first things that a lot of people wanted to go over was like how, because when it comes to long-term investing, you're looking less at the chart and more sort of at the company itself. So what are some good and bad things to kind of look for in that world when it comes to picking long-term investments?
So let me just share my screen. So I think the biggest thing, I know we talked about it a little bit last week where other people like, balance sheet and earnings and stuff like that, where as much as you can read that stuff, you got to be like a accountant. Even for myself, like if I could look at Snap, for example, over the past few years, from losing money consistently, kind of quarter after quarter. They had these little beats, but they were still losing money. And then once they really started to become profitable, that's when the up move really started to come into play, and as they were able to justify that they were a profitable business. But I think that's going to be very difficult for most to kind of systematically do, like by reading the balance sheet, reading the annual reports. I think for most, they might say they will, but the reality is most aren't. So I don't think that you need to spend a crazy amount of time on that topic, because it's going to be very hard to know, should Snap make $5 billion a quarter, or should it make $7 billion? Or, it's going to be hard to justify those. And a lot of it's just going to be really opinion. The big thing for me, more so that I focus on, is understanding the story of the company. And that's where I have my conviction. So, if you look on my list, I have these are my long-term holdings. Amazon, self-explanatory, our books are on Amazon. We're buying off them every single day. I always have an iPhone. We utilize the CRM, having help use ours as well to make sure we can stay on top of the members on certain steps of the program. And without that CRM, we would be kind of blinded and not really be able to offer the service to the extent that we do. CRM, that's what they do. Baba, we sell a bunch of artwork that we get from China and from overseas, and we're paying for the products through Baba. They're taking the credit card transaction. That's where they're making money. Airbnb, we do the trading as for retreats, and I'm booking the homes for Airbnb. Shopify, where our site's hosted, and Etsy is where we're selling all the artwork. And I skipped a few: Teladoc, Bumble, Match, and Uber are the four I kind of skipped, because those are names, even for my own stuff, that I'm starting to realize I don't have the same conviction as. I don't use Uber. I don't go out and party where I need to get a ride home. I'm not doing that. I'm not on these dating apps anymore. I understand the subscription model, and I like that for those two, but I don't utilize that service in the same capacity. And Teladoc, I don't really go to the doctor and need it, but that was more of like a COVID type of play. So for me, it's like I'm going to slowly get rid of the Teladoc, the Uber, the Match, and the Bumble, because those are names that I don't have the same conviction as I do with a Baba or an Airbnb. Now that I help my parents list their home on Airbnb, and within a week of it being listed, a quarter of the year it's fully booked, and they're getting 97% of that rental. Airbnb takes the credit card fee, as any company's going to take. But now that I'm seeing how that business on the other end works, I was using the guest side, renting the homes. Now I'm on also the host side, renting the homes, and even setting up some of the trading experts experiences through Airbnb. Now that I do both of it, I have much more conviction in the name, that when the name is getting smoked, I don't really care, because I'm still going to use Airbnb as a consumer, and also on the business side. So I think that's the bigger aspect when it comes to long term. And that was a big thing, I think, talking with a lot of members who started to use M1 more recently, probably in the last 6 months, was that most were very tech heavy, because leading up until the start of the new year, tech was the strongest, and it was like you pretty much had to find tech names. But the downside was, for a lot of these individuals, is they picked only tech names, and they only picked names based off the chart, not understanding the underlying business. And there's even members who like join me with Baba, but they don't they're not using Baba in the same capacity that I'm using on a daily basis, that even when it is dropping, it's like I'm still spending the same amount of money or more on that site, that my conviction isn't changing until there's a point where I'm no longer using these companies. I'm buying these products from a different site. I'm renting the homes somewhere else. I'm moving, the website from Shopify somewhere. Like, until that happens, I don't really want to change my conviction, but I'll still trade the chart in my favor. Like, I'll continue to buy Baba down here, and when Baba gets back up here, that's when I'll look to sell it. So I think making it simple and appealable for most is just focusing on names that you really believe in. And of course, knowing the fundamentals and stuff like that's going to be great, but it's going to be very hard to, just like learning how to spot a bullfight, take advantage of it. There's a learning curve. And if you want to start diving into reading balance sheets and corporate earnings and listen to earnings calls, there's going to be a dramatic learning curve with that as well. And you're probably going to be very bad at it for a very long time, that it's much easier just to stick with what you have, your conviction with.
Okay, yeah. So yeah, I mean, answer in short is kind of just look around in the world that you live in and look at those companies that you use and that are working well, other people are using them, and kind of use that as your conviction as good long-term investments.
Yeah.
That's not going to scare you out just because it's down 20-30% or whatever it might be, because that you're still doing business with them or you're still using the service. So
and that like in a lot of these like combos where it's like 2020, end of 2021, I have all these names, I want to hold these all long term. And then of course the first lesson when you say that is they all go down, and all these names go down. And now 6 months later, 3 months later, the conviction is now, well, which one of these can I sell to get rid of? And it's like, well, 3 months ago you wanted to hold them for a long time, but now they're all going down. Your conviction is now changed, and that's because you're picking it based off the chart or the ticker, and not really spending the time to determine and even for myself, again, there's a couple of names in here that I also jumped into some of these too quickly, and I don't care about the performance that they went down, but it's just that like I didn't have that real conviction. And for me, I will continue to get more concentrated as time progresses, meaning I'll have less positions on my portfolio. The performance will change much more dramatically as I get more concentrated, but they're going to be in the ideas that, I have more conviction than, just I'm going to buy Uber down here at 30 and I'm going to sell it at 65. It's like, that's great to trade it broadly, but I'm not going to like hold this for, a couple of years.
Yeah. Okay. Makes sense. Next question we had from Shelby, who was, he said, I noticed you previously talked about making your weekly buys on Friday. What advantages are there to doing this? And does it really matter for the long term?
Yeah.
He gets paid on Wednesdays and he just deposits straight from that. So his first buy happens first thing on Thursday. So is there, a difference, or what?
It's not really going to matter, especially in the long term. It's more so, it's like if you, again, there has to be a day you have to pick if you're doing it weekly. And just like we know, it's like Monday morning, like don't chase the Monday morning gap up. For M1, they're doing those buys at 9:30. If you're using M1 Plus, they're going to do them at 9:30 and I guess at 3 in the afternoon. So for me, it was more so it's like we always talk about don't buy Monday morning gap ups. I don't want to have it on Monday if I have to pick one of those 5 days. And typically for most traders, Fridays typically a quieter day. It's de-risking, just overall, not like performance based, just like of those days of the week, you're trying to buy things on Monday, you're often trying to clean things up on Friday. So of those 5 days, if I had to pick one, I would just do Friday because that's typically, a quieter day that maybe the market's pulling in, and I'd rather take advantage of that opportunity than chasing the gap up. Now, and I don't want to go too crazy, but it was like I spoke with Chris Noonan, who brought up that he's doing it daily. And I was like, oh, shoot, how are you doing that? And it's such a simple thing that he just made the weekly contributions for each day of the week, basically doing it daily, that I thought that was even better than the once a day. But I understand the, not the inconvenience, but like the feeling of like every single day money is coming out. And for some people, that's not going to really work. And even for me, like I have a bunch of accounts, I have my own account, there's probably 5 or 6 accounts at M1. So that would be basically 5 debits a day or whatever it is, 30 debits a week of these small increments. Like that could be a lot to, kind of, even though it's the same, if it's $100 a week or $15 a day, whatever, it's the same numbers, but it's actually seeing all those things coming out that I can see that being too much for some people, where like I did it with like one of my accounts, and I'm going to slowly do it with the rest of them where I'll just be buying it every single day. But that also, again, can be, again, you're just seeing your state, like your checking account every day. It's all these transactions constantly could be,
Yeah.
a lot going on.
Yeah, just psychologically too, because like this is a long-term portfolio. So it's like if you're constantly looking at it daily and seeing things coming in and out every day, it kind of removes that set it and forget it type of mindset that we want to keep. So it depends on the person, I would say. Also, if some people are fine doing that and it's going into a bank account that you don't even check every day, and then it's doing those daily things, and that's fine. But I recently moved mine over to Friday. But people always ask me, like, is it better on Monday? Is it better on Friday? And then I just tell them, like, pull up a SPY chart, put it on monthly time frame, and let me know where you can spot the sell off Fridays or the gap up Mondays, and you can't. Yeah. So you have to remember that it's like you're looking at this over many years, not just on the week and those kinds of things. Yeah. So Shelby, I hope that helps. If you want to keep it Thursday, no big deal. Yeah. Gabriel had a question. He's always got some interesting questions. So he says, does the stock's time value of money play a factor in the future market value of long-term investments if they're in a healthy sector? So obviously, like time value of money, he means like money today is worth more than money tomorrow.
I think you're trying to sound smart, but if we were to ask you like why you think that's important, you probably would have no idea other than took an intro to finance class. But like last week, same thing. Keep it simple. Tell me the chart pattern you're going to trade off of, because again, you could do time value money calculations so you turn blue in the face, and it's going to mean absolutely nothing when you buy a stock at a certain price and prematurely sell it, or don't fully trade it the proper way. So that it's way above. That's like a college classroom question that the professor talks about. And in a perfect world, it should be this, but the guy's buying penny stocks and hasn't made money once in the market ever. So that's just kind of, not just in any way, but it's just not going to be relevant to what he's realistically going to be doing in the market. And if he thinks he's going to have to do that much work, try it and see how many hours you spend doing those calculations for the stock to get smoked because people are afraid and people are not making rational investment decisions in the market. No, not even hedge funds aren't even making these types of calculations. Like they're still going to follow crowd theory and things like that. So it's going to overall just be keeping it simple and repeatable. Yes. That's not going to be.
So keep it simple, Gabriel. The other question that he has is how does volatility factor in to long-term holds?
I mean, it depends on your name selection. And that's something where I try to get the newer guys to shy away from recent IPOs within the last couple of years, because the volatility of these names are going to be much more dramatic than a name like Apple or an Amazon, like an Uber here. You bought the flag in Uber, it's long term, thing drops 80%, comes back, to break even, goes 50%, back to even now. So that realistic volatility, the fact that you can realistically be down 80% in a name in a very short time with nothing really dramatic happening. It's just the share, the stock trading and it just finding its footing. But that's where you get a lot of the downside and you don't get the realistic upside. It's not like you're buying, Uber at 15 and top taking at 60. Like that's not going to be the case. You're going to be somewhere kind of in the middle. So that's why with name selection, like the names that I'm focusing on, Amazon, $1 trillion company, not going to expect 1,000% return from this name, but I'm also not going to be in a spot where losing 90% is going to happen within the same year. Same with Apple, same with CRM, even Baba, down, 50 or 60% this year. It's not like this is going to be like a $10 stock, in some time. So with the longer term ideas, at least on my end, I try to focus more on the established names that they're not going to be this dramatic grand slam. I'm trying to hold these names where I can make, 100%. And that's, again, for me, I'm not saying this is the right way, but for me, I'm trying to buy these names that I have conviction in, that I can realistically make 30, 50, 100% within a given year and trade the broader range of that chart, I'm trying to think of one what the hell is it? Like Etsy, for example, was buying it down here, bought it for the whole, bought the most of it down here, added the whole way up, took profits after, like a 60% run up. It comes back in. And now it's like, okay, now it's time to start buying it back again and broadly trading that range of the name. It's not like, it's hard to expect these names to just perpetually grow in infinity. Like when we want like names like Shopify that go from, $20 to 1,500, like that's what we want every stock to do that. But every stock isn't going to do that. There's going to be names that are going to just trade in these ranges. Even like this morning, we talked about C, and this was a stock in college I had to do a report on, and it was a $30 stock when I was in college, and it's a decade later, and it's now a $70 stock. So that's where sometimes you can hold a name long term, even like Microsoft. Microsoft was a $30 stock for decades and decades and decades, and you could have long term held that and hated yourself for it, for 20 years, and then gave it away before it actually has this insane move that is very hard to expect this to be sustainable in 10 years. Like this vertical chart is, with any name, it's just very hard for that to like really sustain itself. So when I hold things long term, it's not that like I want to hold them for 20 years. It's that I'm not trying to trade them. I'm trying to focus more on like the percentage I can achieve within that time frame. That could be 6 months or a year or longer.
Mm-hmm. Gotcha. Yeah. So, mostly it's just kind of zooming out and making sure you're not micromanaging the trade, and volatility kind of decreases a ton when you look at it that way versus trying to just swing trade things or day trade things.
It's going to just be like when your name selection is going to determine the volatility. Everyone wants the most volatile things, and they assume that. And that was kind of like recent with most of the people who were very tech focused. Everyone wanted the upside. No one wanted the downside. And when you want that, for Microsoft, for example, you want that 1,000% run up, you have to expect that with a 1,000% run up, realistically from that high, it can easily pull back 70% and not re-see that prior high for months, quarters, and years. And that's, you have to pick the sandbox that you want to play in. So that's like for some of mine, they're a little bit more conservative, that I'm not expecting 1,000% return in a couple of years, but I can realistically achieve 50, 70, 80, 100%, and then keep moving on to the next thing.
Gotcha. Moving on here, this is not a long-term question, but Dan G did have a question. So he got triggered into that CIVI last week through 59. And that was on Monday. He got triggered in, and he got stopped out around 54, or I guess he had to stop just under 55. And he says, apparently I must have been one of the few that bought into this run early and got shaken out a little bit later in the week versus other members taking advantage of the Friday gain. How do I avoid these pitfalls in the future? And is there a better way to manage stops for someone that does not have the time to watch stock performance throughout the day?
Yeah. So I bought it probably the same day he did. The only real reason that I didn't get shaken out was that it was really a feeler, and so even like for him, I wasn't watching it that closely. I just had my stop below this pivot, and then I had buy stops to add up to 59 through 60. And again, even now, like this is probably going to retest 60. My cost base is 60. Even for me, I'll probably take this off break even, and then it'll tick down to 58, and probably run its way back up, and I'll have to find a new re-entry. But I'm not going to turn this winner into a loser at this point. But for now, the stop's still probably reverse 52, but I'm not going to lose money in this trade. But I think for him, especially when you're not watching names as much, and I'm kind of in that same boat, is buy lighter and give them the real room. So for this, it's like, he could have bought 59, probably bought a little too heavy, where he wanted to keep it very tight, which is fine. And they're going to always get shaken out. Like, it's not always, but like shakeouts are a part of trading. If you didn't get shaken out, it would be much different. We'd be buying bonds, if that was the case. So I think when you're not watching the market as much, buy lighter, go versus like a much more significant pivot than the prior day. The prior day isn't going to be as relevant than like a more significant pivot low. For right now in this CIBI, like the real pivots are 52 and 44. And if say you bought 100 shares and you're giving it versus 55, you're giving it, call it $4 worth of risk. You could have bought 10 shares, which seems like a joke, it's 10% of what you would have maybe bought in that example. But giving it even down to here would have been not even a second thought. And being super light, you could probably just forget about it, set that weekly stop versus that major area. And when this thing probably does drift to 80 or 90 in a few months, you'll probably be one of the few that's still in it, where the more active guys who are buying super heavy through here and kicking into 64 will probably still make more, but they won't be up, they won't catch that bigger move. So that's just something that, if you don't have the time in front of the screen, which is fine, just be light, give it the proper space, and give it the time that it needs to develop.
Yeah, it all comes down to how your life is run, and then fitting your trading process so that it works with your trading style and certain things. So yeah, I mean, why, like you said, wider stops, lighter positions. And if you're having some trouble figuring out where those stops should be, zoom out, look at the weekly chart, because from there you can see a much clearer. The pivot is that 51 level, so that that will help you a lot. Obviously, the risk percentage is higher, but again, your positions are smaller, so you have more room to let them work, and really see what's going on. And then, like, even on the CIVI, you kind of had the opportunity to buy more on that Friday or even the Thursday through that resistance again. So if you're buying light for that initial trade, and it does kind of sell off like it did, where it has this minor shakeout where it's shaking out the people that have that tight stop, but you're still in because you have a small position, you can look to then buy again when it reverses, which is something that I've kind of started to really focus on, is like start with that starter position and then look for that spot that people are getting pushed out, and then then get aggressive on it, because I have a lot less risk, because now it's versus like that smaller, because now I would be versus that little pivot under 54.30, but I have a better position.
Yeah.
And then the other thing also is the theory of just like 5-to-1 risk reward ratio, right? If you took it that one time and then you cut your loss quickly, if you're cutting your loss correctly, you still have the mental capital to go for it again, even just a few days later. So that's the other thing too. It's like you can miss 2-3 times, but you get it on that 4th or 5th time, and it pays off all those other times that you missed it.
Yeah.
But that's kind of for the more active trader, definitely.
I think that part you mentioned is very important. That even with myself, I think with a lot of people, it's like if you take a trade once, like for the CIVI, and it shakes you out, then you're like, all right, screw this, I'm off to the next one. But if it's coming back to that same spot, the probability, like that first time you were buying it versus, you bought, call it 60, just for keep it simple, and you get something out 55. It's getting back up to 60 again, even though you don't want to buy it because it's back up there. That trade is much more likely to work buying it at your price the same time or higher versus that spot you got shaken out from, than avoiding it and saying, like, I'm not going to buy this thing again, I'm going to find something else and figuring it out. Because now that, okay, I lost money here, but this is as low as it could have dropped. So if I'm going to try this again, I get probably much more probably on my side that it's coming back up to the price that I was buying. It's going above this breakout level. And now I know I can give it versus that spot. But again, when this trade starts to happen, things, even now, it's like, I'm not going to give this thing to 55. This is probably, or 54. That's probably the right stop. This probably does shake down through 60 because it's not going to perfectly hold this. And it probably does stay above 54 and then eventually turn itself back up. But I'm not going to, not going to be up whatever it was, 10% in the name, and then give it, 5 or 10% to the downside. I have no problem getting out break even. Mental capital is still fully that I didn't make anything in it, and I can easily let this thing do its thing and then buy it again in a few weeks back up through 60. Or if it takes 60, shakes down, it goes higher, then that's my bad for adjusting the game plan. But that's
I agree. Moving on here, George just wrote in the chat. He said, I was using TurboTax to do my taxes, but since I've been trading, they want to charge me $90 for the additional forms.
Mm-hmm.
Do you guys know of any other sites I can use to file my taxes, or are they all pretty much the same?
So we are doing, this is, we did not ask you to say this. This is like some plug, but we actually have the member who does our tax returns, who is fully doing Trading Experts tax preparation this year. Again, we have a lot of members who saw Etsy with us, and that was kind of the reason why we started it, because tax prep can be very confusing, even trying to teach it. When we talk about retirement accounts, once you mention the word tax, people's eyes kind of glaze over. For Etsy, we had we sent, I think it was 15 1099s this year that we prepared for the individual, which anywhere you go, it's like reverse. It's like you would prepare the return, the 1099 and send it to us. But we're basically starting to do the tax prep. We e-file, we do everything for you, that if TurboTax is going to nickel and dime you, then just, let me, obviously talk to me privately. We're not going to talk on a Zoom call about this, but we can do your tax prep. The big thing a lot of people want to talk about when it comes to taxes is deducting trading expenses, trader sync expenses, trading access membership expenses, any of those types of costs. But for most traders, if it's not your full-time income, it's not going to be something you're going to really be able to deduct. If you have a home office, that's something you can potentially deduct. But a lot of your actual expenses related to trading aren't deductible unless you can justify that it's a primary source of your income. And for most, if you're making like less than $30,000 a year trading, it's going to cost you more, even on our end, to do that tax prep than it's worth just to, not deduct those expenses. But if you do have any tax questions, the big thing is, if you go to TurboTax, you're doing it yourself. Even if I do it myself, I would rarely screw up my return. And yeah, I might save a couple bucks by doing it myself, but I'm going to miss a lot of these deductions that someone who does 4,000 tax returns a year is going to know like the back of his hand. And that's where some people could be, it's like the terms like penny smart and dollar foolish, where it's like someone might want to save money on tax prep, but then you don't, if you were sick for COVID this year, I know that's like a big deduction that our guy is talking with them, like, were you affected? Did you get sick by it? And if so, if you can justify and show you were out of work for this period of time, there's this, I think it's like a $2,000 or $3,000 tax credit that he can, but that's something that we can't prepare. Like I have no idea to do it, but he can do it with his eyes closed. So if you have tax questions, so let me know, and we just do a group call. It's myself with him and you on it. And the big reason for that is most people, when you do tax prep, you're just talking with a tax professional at best, TurboTax doing it yourself. Most people, and the only people that really had this type of experience was when I was at the investment bank I worked at with my clients, it was myself, the advisor, the tax professional, and the client, and us working together, making sure that he's trying to minimize your taxes while we're trying to make sure you're taking advantage of, the retirement accounts. And most people never get that interaction with the people together, all on like in the same conversation. And that's something that we're starting to do. We're doing this year, and we'll continue to do as the years progress. So, if you have any tax questions, just let me know, and we can, discuss it.
Yeah.
Privately.
And just to add on top of that, it's like you have to also remember that you have to treat your trading like a business. And I don't know any businesses where you don't have to invest some sort of money to, to do better and do things over time. Nothing is really going to be free. That just doesn't really happen. You go to any person that's going to do your taxes, they're going to charge you probably a couple $100, if not more. So you really don't want to be cheap when it comes to tools that you need to succeed long term, whether that be, a good trading journal, a good CPA, somebody that can do your taxes, things like that, and a good trading coach. All that stuff counts. So don't try to cut corners when it comes to cost, because at the end of the day, 10 years from now, that $90, if you decide to go with TurboTax or whoever you decide to go with, it's not really going to matter. You're going to be making way more than that. So that's kind of the more important.
It was one of the members I was talking about, where he was like, and again, every tax return is going to be different for most people. Again, it's a W-2 and a trading account. 2 hours of work, 3 hours of work. It's not going to be anything crazy from a cost perspective. But for this individual, he had a lot going on. He had bought a home in a different country. There was like a lot of stuff. It wasn't a very simple return, and he was like worried about the cost. And I was like, the one thing that we found you already that you would have never found or thought to do is like a $6,000 savings for you. That whatever this return is going to cost, it's going to be not even close to 10% of that savings alone. That like, don't focus on the little, whatever costs get done. Just like focus on the bigger, the bigger cost savings. But again, we probably move on from that. I think we talked about taxes enough that we probably lost half the people here.
Yeah. Well, that's pretty much it for the questions. We got like 6 minutes left on the Zoom anyways. But if anyone has some last minute questions right here in the chat, we can go over them. I'm checking over here on my side. I'm not seeing much. But just to recap, I guess, balance sheet's not super important when it comes to long-term investing. Focus more on like real life and what companies are around you, what companies you see all the time. Doesn't really matter what day you're automatically investing in. We choose Fridays because we like the Fridays. We kind of want to avoid, quote unquote, the Monday morning gap downs, but long term doesn't really matter. Yeah, when it comes to getting shaken out, that's kind of part of the game, but understanding, when to strike again or fitting your personal life to your trading style is super important. So if you see that you're getting shaken out of a lot of things, that means, you need to go lighter and just have a wider stop so you can let it fit that less active trading style. Yeah.
And if you need tax prep done, talk to us.
Yes. And we will see you next week. If you have any questions, send them to me. If you're part of Trading Experts, if you're seeing this on YouTube, you can post a picture in the comments or post a comment in the comments, and we'll go over it next week.
All right, guys. Talk to you guys later.
See ya.